This is the review for Friday, January 3rd. The first thing I wanted to point out was on the open here, we were having a breakout mode pattern. And a breakout mode pattern is when basically the pattern is showing that the market wants to break out of the range that it's in. So on the open like this, we have the first bar, and the first bar has the high of the bar and the low of the bar. So there's that range. On the open, when we see the market go above that first bar, like it did here, and then it also goes below it, like it did on bar 5, then that means the market is probing both directions and is trying to see where there are buyers and sellers, and it's trying to figure out where the market's going to go. So when it tests down here, goes below the low, then it goes back up, and then goes back down. These attempts back and forth are basically trying to figure out the direction of the day, because at this point, at any of these points, we don't know yet what the direction is going to be. We don't know that it's going to end up being, a fairly strong bull trend day. So these attempts on the open, those are attempts to figure out the direction of the day. That's why the open can be tricky, is because there are so many reversals, and the market is unsure yet of what kind of day it's going to be. Something I talk about a lot is on the open, anytime you have a reversal bar that has a strong close, like the body closing near its low or at least below the midpoint. So this bar 4 here would be an example. When you have a reversal bar with a strong close, it's reasonable to go for a scalp on the open. And you can see if you did sell below this bear bar and went for 5 points, you would have been able to get out with 5 points. And then we have a bull bar here, this bar 6, closing above its midpoint. It's a reversal bar. You also get your 5 points there. Big bear bar here, closing below its midpoint. That's a reversal bar. There's a scalp there. Now, I didn't mark these because the bars are so large. Let me see exactly how, this bar 4 is a 20-point bar. So the bar is 20 points, and if you're scalping, at a minimum, you should be going for 5 points. But when the range is so large like this, I think you should be going for 10 points. And I didn't mark these because the bars were so large, and I just think there's too much risk. Even when lowering your position size, just for me, I would rather not be, taking these trades. And you can see if you did scalp for 5 points, you would have gotten your 5 points here. But if you went for 10 points, which I probably would have if I was to sell below that, because the range is large, then I wouldn't have gotten that. Now, you would have been able to get your 10 points here above this bar, and let's see, below this bear bar, you would have been filing 10 points there as well. But that's something to monitor, is that on the open, when you get a strong reversal bar, it's usually good for a scalp. But when the bars are large like this, I'd rather just avoid it and wait for a better setup. Something like this. So we have the first bar I have marked here. It's a strong bull bar following 2 bull bars, following a double bottom or a triple bottom. Right, so the open, then the market has made attempt down here, an attempt down here, and we've stuck above the moving average. We've also stuck above the 200 moving average. So good bull bar. After the bears are failing to go lower, good chance there'll be buyers above this bar. And we can see they were able to get both a scalp. So if I was buying above this, I would go ahead and try to go for 10 points because the risk is at least 10 points there. So I want to be going for at least a 10-point scalp. So my strategy there would be to use half your size and then go for 10 points instead of 5 points. And you would have been able to get 10 points there. So I would put my stop below that bull bar and go for 10 points, buying above it, and get out somewhere up here. Other people, especially since it's on the open and the pulse might get a low of the day early, people might go for a swing trade up. So they'll buy above here, and they'll sit through these pullbacks like this and just leave their stop down here, and they'll get out up here. So if you were to go for 2 times your risk like that, I think this is a reasonable swing trade. So it's reasonable to go for a swing like that. Then that would have been 23 points. And I think really everyone, beginners and advanced traders, both should be trying to find a swing trade on the open, because so often there is a large, like 20 point, 30 point move from the open. Usually around this time, like 10:30, usually before 11, there's some swing trade setup that you can take, and you can go for at least 2 times your risk. Sometimes it's better to just try to hold it for the rest of the day, because when you do get a strong trends can last a lot longer than you think. So try to look for these swing trades on the open, and trade small or trade on the sim account, demo account, and just practice trying to take those bigger swing trades and see what it feels like to sit through these pullbacks and be thinking about how you'd want to manage it. If I was to take that swing trade and I did hold through this, I probably would be getting out below this bear bar here. We have double top, possibly after the second leg up here. So when you have these 9 bull bars up, you usually get a little bit more up. Well, this might be that little bit more up, this other bull bar here. Then you get a bear bar. So double top, bear bar, I'd probably be getting out below there. And then the idea, if you are getting out of a trade like that, if the market's showing you signs that it wants to go back up, then ideally you should be getting back into the trade. So, have more buys marked through here. And I'll come back to those in a second, but that's just how you would manage it. If you are getting out of your trade, you want to continue to look for ways to get back into it. Ideally bull bars at the moving average. Let me come back to the second trade I have marked here. So I have it buying above this bar with this tail on top here. And my thinking here is we are starting to really hold above the moving average. So you can see these attempts down. We had no closes below the moving average, no bodies below the moving average. And this attempt down here as well, no bodies below the moving average. When you start to see the moving average kind of cup the market, it kind of molds it and keeps the market going in one direction, then I like to try to look for buys with that, because oftentimes that will lead to some sort of trend like this. You can see this little box I have drawn on here, the gap, and every day that I have a review of the E-mini, I'm going to be talking about these little gaps. These little gaps are the best sign that a trend might be occurring. These gaps are early signs. So, if you say, I want to catch these big moves, these 30-point moves, I want to be in the trend, and I want to be swing trading and holding the position for several hours throughout the day. Well, if that's what you want to be doing, you need to keep monitoring these gaps. And so looking at this, we have a bull bar and the high of that bar. Then next bar breaks out above it. And then the bar after, the tail does not come back and overlap that bull bar. So there's a gap right there. And what's happening, like the actual underlying mechanism, what's happening is people see this as a trading range. So they're selling above bars. Some are even selling above a bull bar like this. So if they're selling here, they're trying to go for a scalp, and they're willing to scale in higher. So let me draw it on the chart here. They'll sell here, then they'll scale in higher at some point, depending on what their strategy is. So they sell here, sell more higher. For them to make a profit on their second trade and break even on the first, it has to come back to their first entry. So if they're selling here, they'll sell more higher. They can choose to get out break even right here. But for them to actually make a profit, it has to come back to their first entry. So that's why these gaps are important, because if people are selling above this bar, and they're unable to get a profit, then they have to buy back their shorts and they have to get out of those short positions, which is what causes these big moves up like this. So when I start to see gaps, multiple gaps that are staying open, like here, and then we have another one right here, and another one right here, that's an early sign that we might have a larger move up. So I'm always drawing these gaps on my chart. Like example, on the first 3 bars here, I have the high of bar 1. I'll draw my box on like this. And then once bar 4 forms and it overlaps this gap, then I go ahead and take it off. And I keep on doing that. And that kind of keeps me in tune with the market. When I see these gaps getting filled instead of staying open, and to me that's a sign of a trading range, or at least that the market is not trending yet. So I would draw my box here. I'll draw my box here, but then this bear bar overlaps it, so I would remove it. And I'm doing that all throughout the open. And then when you start to get these gaps that do stay open, I have this gap here. Like when this was happening live, and I saw that gap open, I'm thinking there's a chance we're going to have a strong move up, that we're going to have a trend up for several hours, especially after double bottom on the open. We're staying above the moving average. There's confluence, there's signs that the market is wanting to go in one direction, and the odds are increasing with these gaps that we are going to get that. So I like the idea of buying above this either of these bull bars here, this bull bar or this bar with this tail. Often the open will be a trading range, but like I was saying, that trading range is just occurring because the market is trying to go both directions, and it keeps doing that until it finds its direction. And you can see signs that the market is building strength in one direction, and so it's okay to be betting on an early breakout, like buying above this bull bar here with this tail that I have marked. It's okay to be buying there, either for a scalp or for a swing trade up, because there are signs that the buying pressure is increasing, and you can get a chance at an early low and potentially get a lot of reward. Your odds of buying above this are lower than if you were buying up here or somewhere over here. Your odds are lower, but your profit potential is larger. So the math works out that it's essentially an equal outcome, equal expected profit versus like buying above here compared to over here. So coming over and looking at these trades I have marked here, I want to point out something really important. We have another gap happening right here. As this pullback goes down, look at this tail and then the high of this bar over here. They actually hit perfectly. They come right down to the exact same price. Now that's still a gap. When they come back to the same price, that's I still consider that a gap. When I see gaps, I like to draw in a measured move. So different ways you could do it. I'll do it from the low of that bar and draw it in like this. So basically we have this first range here. Oftentimes that range will double, which we almost got that day. And then when you have this gap that, and kind of in the same way, that also ends up being a measured move up. So from the low, from the low of this range here to where the gap is, and then oftentimes that'll lead to a measured move up. So that measured move target, it becomes a target, and then it increases your chances of making money when you're buying above any bars and buying in this trend up. So I really liked seeing that gap there, especially coming back to the moving average, testing the moving average. Look at the day where the whole day's been kind of cupping and holding along and keeping the market up. So when it's doing that, it tends to continue doing that. Another thing we have a wedge. So we have a 3 push pattern: first, second push, third push, which is, well, it's a reversal pattern, but in this context, we're in a bull trend, and then this pullback. So a wedge would be reversing the pullback, which means we'd be continuing back up. So strong buying through here, wedge, likely to lead to higher prices. So I like the idea of buying above here. I think this is better for a swing because, like I said, you do have, if the market is going to come up here, you do have so much profit potential. So I think that'd be better for a swing, going for 2 times your risk or so. And you really wouldn't have that much pressure. I mean, you buy above here, you just leave your stop down here. Probably wouldn't get out here or here. And, you know, after that, you never really have a good enough bear bar to get out below. And, you know, basically market would just run up and get you out. Similarly, I have here both of these bars that I have marked. Basically, this is just buying above a bull bar in a bull trend. All right, so the market's moving up. I want to be trying to find ways to get long. Buying above here, and if you put your stop below it, you would have been stopped out. But any of these bars, I think, would be reasonable to be buying above. And if you did, then you would have made back your profit on that. So, I mean, look at the bars I have marked here today, and I actually could have marked, more bars through here. I can go ahead and do that. Remember we still have this target up here. So, what's the idea? You know, buying above bull bars in a bull trend, especially when we still have targets above, and especially when we're still getting gaps. Look at this high, and then break out and then pull back. That's another example. The market came right back down to that price, but did not overlap. So there's still a gap there. So the market's still strong. I still want to be buying above bull bars after pullbacks, and buying above bull bars above the moving average. So that's my thoughts on today. The market is starting to slow down a bit. Like, the volatility is starting to decrease a little bit. So in the open of today, we were having these big 20-point bars. And then in the second half of the day, it was back to its normal, 5-point bars per 5 points or so. So actually, you could go back to trading your full position size on some of these bars through here. I do prefer when bars are more in that 5 or 6 point range instead of large bars like this. In theory, there's more money to be made when the volatility is higher. But I just like having that consistent, 3-point to 6-point bar. I'd rather have that consistency where every, several times a day or once a day or a few times a week, I can rely on having the same kind of setup on the same size bar. Instead of having these large bars where your risk is large and you have to adjust your position size, it just kind of adds complexity to it. So even though volatility is better and potentially you can have more profitability, I'd rather just have the kind of the same boring days with normal size bars. So that's just my thoughts on that. And let me pull this up. January 9th, the market's going to be closed for Jimmy Carter's passing away. So on the 9th, don't wake up expecting to be able to trade. Like that says here, stock markets will be closed, post office closed. So, go ahead and plan on being off that day, and plan to do something else and enjoy your time off. So just a heads up there. All right, guys, see ya.